Shares of the Walt Disney Company are up nearly 21% year to date and seeing another 6% gain after reporting their Q4 results. We'll get into these numbers and see whether these gains are justified, see also whether in the next few years these gains can be replicated, and if buying shares of Disney near $110 would make sense. We'll take a look at it from a technical perspective as well. Really, over the last decade, you could have bought shares of Disney back in March of 2015 and you'd probably still be flat on your shares. So we'll highlight it from a technical perspective, see where the opportunity lies in the Walt Disney Company. Hey guys, hope you're doing well out there. It's been a while since we've taken a look at the shares of Walt Disney. Year to date, you've seen the gain of nearly 21%. Some of those gains coming today after they reported their Q4 results. Shares popping nearly 6% on the trade. You're also seeing this one now trade closer to a 21 times an earnings multiple. Certainly not egregious, maybe not as high as we've once seen Disney, but I wouldn't say all too cheap as well. Now, the top line figures look pretty solid over at Disney. Revenues growing at 6% year over year, up to $22.5 billion. That essentially came in line to what analysts expected. They also came in line with their bottom line non-GAAP EPS of $1.14. They also achieved pretty strong segment operating income growth of 23% in the Q4. This was also the end of their fiscal 2024, and so they, for the full year, achieved nearly 21% growth on that operating side. So we'll definitely highlight and really jump into the nitty-gritty on these operating results, because from their entertainment business, it looks absolutely stellar. You're seeing revenue growth, you're also seeing operating income absolutely explode, but all of that comes at the cost of maybe some of their other parts of the business, which nearly aren't doing as well as they once used to. Now, this company also provides guidance, not just for the upcoming fiscal year, but in fact, a bit of guidance for the fiscal 2026 as well as fiscal 2027. So kind of a 3-year outlook, if you will, that Disney provides to investors. Now, for the upcoming fiscal, they anticipate nearly $15 billion in cash provided by operating activities. Another $8 billion in capex is what they expect. So if you do the math on that, nearly $7 billion in free cash flow is what you're expecting with Disney over the next fiscal year. And for a $186 billion company, that's right around a 3.7, maybe as high as 4% free cash flow yield. And so certainly not anything to write home about, but again, it's not overly terrible either. Now, from my perspective, I think this company does certainly have a lot of capex, and so from that perspective, I would like to see this company closer to maybe a 5, even 6% free cash flow yield. That's where I personally would feel more comfortable buying in, or at least holding shares of Disney, when I get a bit more of a free cash flow yield, simply because of the high capex nature of this business. They also expect dividend growth for the upcoming fiscal year, roughly in line with earnings growth, roughly in that high single-digit range, and then they're also expecting to mitigate some of that dilution through the form of stock buybacks. Now, like we said, they also provide guidance for the upcoming fiscal 2026, which is really 2 years out over at Disney. And for that year, they're expecting double-digit earnings per share growth. And in fact, for the next fiscal year, they're expecting right around high single-digit earnings per share growth. So this company is telling you in 2026, they expect to sort of outpace the earnings growth that they expect for the next fiscal year. And then even for fiscal 2027, they anticipate another year of double-digit adjusted earnings per share growth. So this company is telling you that they expect earnings per share growth to accelerate in the upcoming years, especially in year 2 and 3 from now. They expect those earnings to be much better than they were this year, especially much better as well as next year. So that guidance certainly was pretty good. In fact, that's probably what's assuring investors just a little bit. The other thing that's keeping investors happy, at least for now, is the fact that the entertainment segment is proving to be a very, very solid, profitable boost that this company really needed. And we'll dive more into that. The entertainment business consists of the Disney Plus segment, also absolutely consists of the Hulu segment. And one of the reasons why the entertainment business is growing so nicely is because you're growing the core subscribers, you're also growing the average revenue per subscriber in really all of your markets. So domestic subscribers on a quarter-over-quarter basis increased nearly 1.3 million on that Disney Plus side. Year over year, you saw nearly 10 million additional Disney Plus domestic subscribers. So that's very solid growth from that Disney Plus platform. They also saw growth on the international segment, both year over year and quarter over quarter. The other thing I want to point out is on the average revenue per user side. So for a lot of these companies, we see the average revenue per user, or ARPU, in international markets be significantly lower than the average revenue per user in the US and Canada. And for Disney Plus, that's not the case. In fact, for Disney Plus, you're seeing faster growth in the international side, and you're seeing slower growth in the domestic side, but the difference between your average revenue per user, both internationally and domestically, isn't actually all that different. And so the nearly 66.7 million subscribers on the international side do actually contribute significantly towards the Disney Plus overall revenues, and that's good to see. They're seeing subscriber growth along the board. They're also seeing average revenue per user growth along the board, and especially in the international markets, that is key over at Disney Plus. Now, in terms of the different segments, we have to talk about the three segments this company has. The first one being the entertainment side. That's what we just looked at. So the revenues on that side of the business growing 14% year over year on a quarterly basis. For the full year, relatively flat, up just 1%. So this quarter proving to be rather good over at Disney Plus. The sports side of their business, they're seeing revenues flat both on a year over year and on a year over year quarterly perspective, as well as a full year perspective, seeing just 3% growth. And then the experiences side of their business, which continues to be a relatively large business, it's just this company is really unable to grow it on a year over year perspective, up just 1%, and for the full year up nearly just 5%. So you're not seeing explosive growth on the sports side, certainly not explosive growth on the experiences side. And I think in the first half of next year, you'll still see some pretty explosive growth on the entertainment side, but a lot of that comes at the cost of maybe their other businesses. The other really important thing about the entertainment side is the fact that your operating income is absolutely skyrocketing. So you nearly 5x your operating income year over year on that entertainment side of the business, from $236 million up to nearly $1.1 billion in quarterly operating income. For the full year, you again went from 1.4 up to nearly $4 billion in segment operating income. So that's absolutely phenomenal to see. Again, one of the reasons why you're able to grow your segment results nearly 23% year over year is largely due to the fact that your entertainment side of the business is really turning the corner from a financial perspective, and you're seeing that in the operating side of the business. Now, that does certainly come with its push and pulls, and so you have to dive into the details. In fact, the devil certainly is in the details when it comes to Disney's entertainment side of the business, because you're seeing phenomenal growth on that direct-to-consumer business, which again, I want to point out is Disney Plus, as well as Hulu. I think even ESPN Plus comes underneath this direct-to-consumer. And so you're seeing pretty solid growth on that business, 15%, but that is coming at the cost of your linear networks declining on a year-over-year perspective. So the linear networks, which includes ABC, is down nearly 6% year-over-year from the revenue side. For the full year, you're down nearly 9% on your linear network. So I want to point out the growth in the direct consumer business for Disney is absolutely coming at the cost of the growth in the linear network segment. And if I was to compare this to a company like Netflix, which is a pure play direct to consumer business, yeah, they don't have a problem like this to deal with, because they're not having a linear network side of the business, which they have to sort of offset in the form of direct to consumer. For the case of Disney, that is absolutely a big concern, because you're seeing the growth in the D2C business, but at what point does people moving into streaming and Disney Plus hurt the fact that this company still has a relatively big linear networks business? You're also seeing the same story from an operating perspective. While you're seeing your direct-to-consumer operating income go from a loss of $420 million to now a gain of $250 million, you're seeing that being offset on the operating income side of your linear network, down nearly 38% year over year. Even for the full year, it's fantastic to see this company has turned the corner on their Disney Plus and Hulu business. But again, that's coming at the cost of your operating income on the linear network side. So at some point, maybe do you expect linear network full year operating income to drop to $3 billion, then $2.5 billion, then maybe even $2 billion? And all that same time, you'll probably see growth in the D2C business. But again, that will largely, in my opinion, be offset by the declining operating income on your linear network side. So keep that in mind. You're seeing phenomenal top line growth on the entertainment side, but again, that is coming at the cost of their linear networks, which continue to see declining revenues, declining operating incomes. And that's something to keep in mind, especially for their competitors like Netflix, which really has the crown on the D2C business. They don't experience something like that. The other thing I do want to point out is the sports and experiences side of their business continue to see dwindling operating income, at least on a year-over-year basis. For the full year, you're still seeing relatively flat operating income on those segments. So this company needs to figure out a way to be able to grow on the sports business, also especially grow on the experiences, which includes the theme parks, also includes the Disney Cruise Lines. And so that's a portion of their business which sees huge amounts of capex, but you're not seeing an ROI on that capex. So really questions have to be asked whether the capex into the experiences side of the business is justified, or whether the growth can ever return to that part of the business, because it still makes up a relatively large portion of their overall revenues. Nearly a third of their yearly revenues comes from that experiences side. So there's still some questions around the experiences along with the sports side of their business. Now, in terms of a balance sheet, you also, again, when you're investing in a company, you want to invest in companies with fortress balance sheets. Disney, unfortunately, doesn't have that. In fact, it has a pretty weak balance sheet, and you can see that by just taking a look at the cash year over year, down from 14 billion, now down to just 6 billion in cash and equivalents. You have another 12.7 in receivables, and then your total current assets coming in at $25 billion. Now, this company does have a fair amount of licensed and produced content assets. That includes the movies that Disney produces. Also, they have a large amount of assets tied into the parks, resorts, and other attractions. Now, with that, you do see a fair amount of depreciation every year, and so that's one of the reasons why this company needs to do a large amount of capex on that parks and resort side. But again, a lot of their assets are sort of tied into these intangible things like licensed content assets along with parks and resorts. The problem over at Disney is the fact that a lot of their debt is straight in the form of borrowing. So they have nearly $6.8 billion of short-term debt, have another nearly $39 billion in long-term debt. So in fact, their total current liabilities come in at $35.5 billion, offset by just $25 billion in current assets. So from a balance sheet perspective, it's not looking good over at Disney. They have just still a large amount of debt, despite the fact that it's sort of declining on a year-over-year perspective. Some of that is just being transferred into short-term debt set to be matured over the next 12 months. And again, I want to point out the debt, what that does for this business, it causes them to pay nearly $1.3 billion in interest expense for the full year. Even last year, they paid nearly $1.2 billion in interest expense for the full year. And that's meaningful for a company that's generating right around $7.5 billion of income before income taxes. So shaving off $1.2 billion off of that certainly is impactful for a company that's, again, not really a super high margin business, especially due to their parks and cruise lines and the sports side of their business. Now, the thing I really want to pay attention to over at Disney is the cash flow statement. We come down to nearly $14 billion of operating cash flows. Now, one thing I want to point out is year over year, that is pretty solid, up from right around $9.9 billion same time last year to now $14 billion. But I do want to highlight this company in their outlook is guiding for nearly $15 billion in operating cash flow. So in fact, next year, you'll see just a modest $1 billion increase on your operating cash flows. The other thing I want to point out is this company did close to $5.4 billion in capex this past 12 months. And for the next fiscal year, they're guiding to do nearly $8 billion in capex. So in fact, you're probably expecting your free cash flows over at Disney to decline on a year-over-year basis as you look ahead to next year. And so that should tell you, from a free cash flow perspective and a free cash flow yield perspective, you actually probably don't have a lot of upside over at Disney, at least for the next 12 months, because you're expecting that capex to go from 5.4 billion up to 8 billion, despite only raising your operating cash flows from 14 billion to $15 billion. And that's, again, one of the other things that I keep going back to Netflix, because as an investor, you have the decision to invest your money in a company like Disney. You also have the choice to invest your money in a company like Netflix. And Netflix certainly doesn't have the problem that they need to invest a lot of capex into parks, cruise lines, and resorts. And they can instead take all of their operating cash flows and plug that into new content assets. Over at Disney, you have a lot of push and pull and a lot of decisions that need to be made, because if you invest heavily in parks and resorts, you simply don't have enough operating cash flows left over to then invest heavily in content assets as well. And we know from a very competitive streaming industry, the streaming provider that has probably the best content assets will ultimately come out on top. Now, over the past couple of quarters, Disney has produced some stellar movies like Inside Out 2, as well as Deadpool and Wolverine. But again, a lot of those movies take high amounts of capex and investment. And if this company isn't able to do that from just their operating cash flows, yeah, they'll certainly continue to fall behind Netflix in terms of the streaming race. Now, with that nearly $6.8 billion of cash used in investing activities, they're left with right around another call it $7 billion in cash from operating activities. Now they do look to deploy some of that in the form of dividends, nearly $1.4 billion, another $3 billion in stock buybacks, and they look to refinance and pay out a little bit of that long-term debt, which in my opinion, this company should look to pay out much faster. But overall, if there's one thing you should look at when you're analyzing Disney, it's the statement of cash flows. I think this tells you really everything you need to know. You have operating cash flows of nearly $14 billion, expected to grow to up to $15 billion. You're expecting that capex to nearly double year over year. And again, you have a large amount of debt, which you're not really able to pay simply because you also have that dividend. You're also trying to do a share buyback. So you just have a lot of ways to spend money over at Disney, and you're simply not bringing home enough operating cash flows to justify all of those expenses. So again, that tells me from an investor perspective, this company really is stretched thin based on what they can do with their cash, and you really have to have a very long-term outlook in order to see some of those big bets like Disney Plus and Hulu pay off meaningfully. Also, how this company will adjust with the fact that their linear networks, as well as the sports and experiences side of the business, really aren't doing that well. So those are my concerns over at Disney. I think, yeah, the entertainment and the streaming part of their business is doing well, but if that's the reason I wanted to buy Disney, I would actually go ahead and buy Netflix. Now, from a technical perspective, I have a nearly 10-year chart pulled up here for Disney. This is on a monthly timeline, so each green and red candle is roughly a month, and you've seen some level of support right here at $86. That's where Disney started the year, and then you're seeing a level of resistance up here at $110, $111 a share. I'll zoom in a little bit because again, you're seeing that resistance come into place anytime Disney hits its head on that $110 range. It's really unlikely to come in here and poke its head out of there. Now, from a trading perspective, not overly exciting because you want to see a decisive breakout over this $110 range, and then you have upside to maybe $120, $123. But again, you have some downside back here in the 80s, if not $90 range, and that's really where I would expect shares of Disney to trade out. You can probably expect some sideways consolidation continuing between this 87, call it up to $110 range. Now, you could look to play the pops and drops within that range. Certainly, that's not something I look to do as a buy and hold investor. But again, from a buy and hold perspective, you really haven't seen this company break out of this channel since January of 2015. To have that happen, you need to see a decisive breakout above $123 a share, and then you want to back test that in order to confirm a set of higher highs. Until you do that, I think Disney certainly should be locked in this sideways consolidation, and probably down here at the $90 range. That's probably where you can look to maybe step in, pick up a few shares in order to make that successful trade. That was my take on the shares of the Walt Disney Company. Even a year ago when we last analyzed this, there were a lot of question marks surrounding their D2C, Disney Plus, especially their entertainment side of the business. While at least some of those questions have been answered and they're seeing some subscriber growth, they're also seeing solid operating income growth in that parts of the business. The question marks, for me at least, continue to remain on the experiences side, on the sports side, and then as always, they continue to remain on the cash flow side, is how this company will continue to grow these operating cash flows meaningfully while controlling those capex investments. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.